Hello, hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Thursday, the 7th of November 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, we will kickstart what has taken shape yesterday in terms of, the all-important news event will be the outcome of the US presidential election, superseding whatever potential upcoming macro data that could have an impact on the broad-based cross-asset classes intraday performance. And also later I will share with your intermarket dynamics, what are things to look out for. So that will be much more of a longer term basis. That means, i.e., we're talking about from a multi-week to a multi-month basis when talking about the intermarket dynamics. And also I'll round up with the short-term intraday technical outlook on the broad-based cross-asset classes in terms of the key levels to look out for, and as well as today's upcoming key economic data that we need to pay attention to, or events that could potentially impact the movement of these broad-based cross-asset classes. So let's start what has taken shape yesterday. So we know that yesterday Trump has already been elected as the 47th US president. Very clearly, 295 electoral votes going towards Trump. Harris only managed to get 226, and also Trump also managed to win the popular vote as well. So what's interesting over here is that the Senate right now is also in the hands of the Republican. So we know that there's a balance of power in how laws are and policy are being passed in the US. Yes, the US presidential election can veto certain policy. He can just suggest certain policy, but the Senate and the House got to actually approve this policy. All right. So the Senate is already controlled by the Republicans. So right now is in the House. So very likely the Democrats will actually lose the House as well, because right now the number of seats the Republicans are getting is 205. So in terms of mathematically, very hard for the Democrats to actually fight back with the amount of votes that are still counting in the various states, all right, especially on the western side of the US. So very unlikely that the Democrats were able to gain control of the House. So what we could see right now is a clear Republican sweep. Okay, so with a clear Republican sweep that is coming into the next 4 years or so, then we talk about midterms. Midterms about 2 years from now, where there will be another so-called voting in the House and the Republican. But from 2 years from today, policies that Trump proposed will be highly, more or less, passed in whole, maybe just a slight adjustment. So that actually put the Trump trade into the forefront. So Trump trade, that means we are talking about bullish in the US dollar. Why? Because of his generous tax cuts. So what we could see over here is this is the Trump proposed policy. Okay, in terms of taxes. So what Trump wants to do over here is that he wants to cut the corporate tax from 21% to 15%. All right, so that potentially could actually widen the US budget deficits over here. And with a widening of the US budget deficits in terms of economic 101, the US 10-year treasury yield will rise as well, because widening of budget deficit, in order to actually fund this budget deficit, you got to actually entice lenders with higher interest rate in the US. So that's why the US 10-year treasury will push up. So we will push up in the US 10-year treasury yield. We also see the dollar rising as well. Okay, so based on what we see over here, let's look at the chart. Okay, so starting with the US 10-year Treasury yield. Okay, so the US 10-year Treasury yield also rose, and yesterday it broke above this key major resistance of 4.4%. Okay, of 4.4%. It broke out, it staged a bullish breakout. So what you could see over here is that in a multi-week to multi-month perspective, the trajectory of the US 10-year Treasury yield is more or less likely heading towards the 5% to the 5.2% next resistance level. So if you look at this push up in the US Treasury yield from 16th of September all the way up to yesterday's US presidential election outcome, it's been moving in line with the general dollar strength. So for general dollar strength, we can take the US dollar index as a gauge of where the dollar is heading. Okay, so similar as well, end of September. So the US 10-year Treasury yield actually moved ahead first. It goes up here. So what you see over here is that the US dollar index hit the major resistance. It hasn't broke yet, but the 10-year US Treasury yield has already broke its parallel resistance at the 4.4% level. So in a way that this 105.5 slash 106.37 is very similar to the 4.5 resistance that was highlighted in the 10-year US Treasury yield. So very similar to this descending trend line that was in place since 2nd of October last year. Okay, so if you go back to the US 10-year Treasury yield again, okay, what you see this major former descending trend line was also, this was in 20th of October. So more or less is occur in the same month. Okay, so what you could see over here is that means potentially going forward, there could be much more dollar strength coming into the picture, given that the 4.4% resistance level on the US 10-year Treasury has been taken out, then potentially, because that is a kind of a leading, a leading price asset classes moving ahead of the strength or the movement of the US dollar index. So means potentially, that US 10-year Treasury yield has kind of given a pre-bullish breakout condition on the US dollar index to go above the 106.37 level. Yes, in the shorter term, you may see a bit of consolidation, but from a multi-week perspective or a multi-month perspective, the odds are more skewed towards a bullish breakout of the 105.5, 106.37 major descending trend line resistance that is in place since 4th of October last year. So if this is the daily chart, so if you look at the weekly chart of the US dollar index, okay, it's also bullish as well. Why? Because if you look at the RSI, if I could draw the RSI, okay, in parallel with the descending trendline resistance, the RSI has already shaped this pre-bullish breakout. Okay, yeah, it already shaped that pre-bullish breakout. All right, so net overall, in a multi-week to multi-month perspective, yes, yesterday the dollar strength rallied to almost a high that was seen around back towards a 6-month higher. It's about going to the high of June 2024. So that's about close to about 5 to 6 month high. But in a longer term trajectory, the dollar seems to be heading potentially much higher as well in terms of the dollar strength. In general, I will say in general. Why? Because this dollar index over here don't comprises all the, we call it a currency in the whole world. So primarily they are actually weighted by three major currency: the euro dollar that has a highest weight, followed by the sterling, as well as by the yen. All right. Okay. So that's the yesterday's movement of the Trump trade that has an impact on the FX markets dollar strength. And also, despite this 10-year US Treasury yield that is inching upwards, that means indicating there is a high risk of this higher cost of funding coming back into the US economy. Because don't forget, the US 10-year Treasury yield is actually a risk-free rate for long-term interest rate that's used to price corporate loans, housing loans, and as well as consumer loan in a way. All right. So with this 10-year US Treasury rate inching up 5% and much higher, the US Federal Reserve right now will have a tough job of later I'll show you the Fed funds futures, where are they pricing. We have the tough job of going into a very deep and long interest rate cut cycle, and also fundamentally it doesn't support as well if Trump corporate tax cut and as well as the trade tariffs are medium term to long term inflationary in nature. So back to the other Trump policy is having to cut corporate tax rate to 21% to 15%. It will widen the budget deficit. Longer term, it will be inflationary pressure will come back into the US economy, and there's also a risk of this 60% blanket tariffs on all Chinese imports to US, and additional about 10%. So right now, he also even proposed up to 20% of all imports coming into US, regardless of country of origin. So if this were to be imposed, very likely China will hit back with some retaliatory tit-for-tat measures together with other countries as well. So that could also potentially see imported cost of raw materials coming back into the US at a higher cost. That means the overall cost of goods in the US will get higher as well. So that will be potentially inflationary in nature. So that will also cause the Fed to unable to ignite a deeper and longer interest rate cut cycle that they just kickstarted 2 months ago. But however, the stock market totally ignore this inflationary pressure, and they choose to focus more on the upcoming corporate tax cut of 21% to 15% that boosts up this positive feedback loop into the US stock market, where we start to see all the major US stock indices rose very sharply. In fact, they start to rose in early Asia session yesterday via the futures market. At the end of the day, the SPX, the Dow Jones, all closed at fresh all-time high. So the one that is leading very strongly is the Trump trade. Still recall that initially I shared with you that this, later I'll share when I cover the intermarket dynamics again, that this bull steepening of the US 10-year Treasury yield curve, potentially together with the Trump trade that is now in the forefront, that could start to see outperformance of the Dow Jones Industrial Average and the Russell 2000. So the Dow Jones Industrial Average, why outperform? Because it's heavily more weighted towards financial stocks. JP Morgan, Goldman Sachs, these two of them are heavy weightage component stock in the Dow Jones Industrial Average, where very likely will benefit from these lower tax cuts, and as well as Trump's some other sub policy is to actually deregulate the financial sector in the US. So that benefited, and the Russell 2000 is also more or less benefited from the tax cuts as well, because majority of the Russell 2000 company, I would say it's 70% or 80% of these component stocks in Russell 2000 are heavily dependent on the US economy. So market choose to ignore the negative impact of wider budget deficit and higher trade tariffs against the rest of the world that could impact longer term inflation pressure in the US, but choose to be bust in the optimism mood in the short term that push up the Russell 2000 to 5.84%. So later so net overall, given this very strong positive animal feedback loop that is going into the US stock market, so from a short to medium term perspective, there could be still some form of potential upside, but intraday there could be a potential pullback after yesterday very steep movement. So I'll cover that during the short term intraday technical outlook on the Nasdaq 100 and the Russell 2000. All right, so that is the key event that took shape yesterday, and as well as how does it impact the major US stock indices and the FX market. All right, so now let me focus more on the intermarket dynamics over here. So on the intermarket dynamics over here is that let's take a look at this inflationary expectation in the US. So what I could see very interestingly, right, this chart that I share with you all, right, notice that this dark blue line and light blue line is the US 5-year break-even inflation and the US 10-year break-even inflation. So this break-even inflation, right, is not based on survey, it's based on TIPS, the US Treasury inflation protected bonds, how they are being traded. And that means it's based on a market expectation based on real money at stake. And take it away that this 5-year break-even inflation and 10-year break-even inflation that is being inferred from the US Treasury inflation protection bonds are future inflation rate that are being determined by these transacted market prices. What is it going to be 5 years from now and 10 years from now? And the purple line is the 10-year US Treasury yield. So this 10-year US Treasury yield can be used as a gauge of two proxy, economic growth and as well as long-term inflation growth as well. So you look at the 5-year and the 10-year inflation break-even rates over here in US. Previously, it went to as low as around 2%. All right, when the Fed is about to kickstart its first interest rate cut in this current cut cycle in the month of September. So it dipped down to 2%. All right, for both the 5-year and 10-year, around 2%. So that was actually in line with the long-term target of Fed getting inflationary pressure to be at the 2% level before they are comfortable starting their interest rate cut, which is in September. But what's interesting right now over here is that the 10-year and the both rose very steeply, and yesterday they rose again as well after Trump confirmed to be the 47 US president election, and also potentially the Republican will win the House as well. That means a clear sweep of the Republican in terms of balance of power, which I covered earlier at my start of today's daily dose and its implication. So right now, the 5-year break-even rate and the 10-year break-even rate actually rose very steeply to 2.46% for the 5-year and 2.38% for the 5-year, way above that 2% target that the Fed wants to be desired to be at this constant 2% level before they starts to actually engineer more interest rate cut next year. So you notice that this push up in both the 5-year break even and the 10-year break even inflationary rate. That means in future inflation expectation, US going to inch higher, which I explained to you earlier on. Why? Because of that Trump policy. That could also lead the 10-year US Treasury yield keep on inching up higher as well. That means, i.e., the US Fed funds rates, the Federal Reserve Fed funds rate may not be going down lower and lower as initially expected. That means it's going to be a rather shallow interest rate cut cycle this time around. And we know that stock market also thrive on liquidity. All right. So if there's going to be a tightening of liquidity, or liquidity is not as loose as what they are expecting initially, potentially somewhere along the line, there could be some form of significant market correction coming back into play again, somewhere very similar to what we see earlier 2 years ago, around in October 2022 to October 2023. Okay, somewhere around this period, there was actually a fear of this inflation pressure being hitting back into the US economy. But for now, at least in the short to medium term, the US stock market are still being buzzed in this Trump trade positive narrative, which is the corporate tax cut. So this is what another intermarket dynamics I want to share with you all is, where is it? Hopefully it's out here. Give me data. Not this. Is this the one? Yes, this is the one. So still recall that initially there was this potential bull steepening that took shape. So this bull steepening continues, all right? This purple line shape up, that means the 10-year US Treasury yield now is rising as a faster rate compared to the 2-year, all right, the 2-year. So with this bull steepening taking shape as what it did, what it did previously in the past during this point in time was actually the end during what I call the pandemic period, where we start the Biden administration starts to issue that very massive fiscal stimulus check that causes Dow Jones Industrial Average and the Nasdaq ratio and the Russell 2000 and the Nasdaq ratio to actually inch upwards over here. And so far, right now, they are inching upwards as well by forming a very clear higher low. All right. So going forward, on a multi-month perspective, very likely the Dow Jones Industrial Average will actually outperform the Nasdaq, and the Russell 2000 will also outperform the Nasdaq. Okay, so this is talking about outperformance. That means, i.e., if the bull market continues, it means this optimism of corporate tax cut from the positive side of the Trump trade narrative continues on the US stock market. That means, i.e., higher chance for the Dow Jones Industrial Average and the Russell 2000 to rise more than the Nasdaq 100. All right, but however, if the stock market in general starts to face that negative feedback loop of higher inflationary rate coming back into the US economy, leading to less potential of the Fed to continue its interest rate cut cycle into next year. That means perhaps they just cut by 2 or 3 times, tighter liquidity, and next year Trump starts to pass his trade tariff policy, and potentially we'll start to see a lot of chaos coming into the market where impacted countries like Europe, US starts to actually unite trade barriers against US services as well. That could potentially kickstart a negative feedback loop into the US stock market. But when that's happened, most of majority means stock market will tends to fall. I mean, most of the major US stock indices actually correlate one another in general. So with that, that could actually cause a negative feedback loop in general to the 4 major US stock indices. But with this bull steepening US Treasury yield curve in place, that means the 10-year US Treasury keep rising at a faster rate than the 2-year. The fall of the Nasdaq 100, the fall of the Dow Jones Industrial Average and the potential fall of the Russell 2000 potentially will be lesser than the Nasdaq 100 and the S&P in some sense. That means this ratio can continue to rise, all right? Given the fact that 2 things can happen, either Dow Jones or Russell 2000 rose more than Nasdaq 100, or Dow Jones Industrial Average and the Russell 2000 fall lesser than the Nasdaq 100. Okay, so this is something I want to stress. It doesn't mean that this ratio is rising. It means that the Dow Jones and the Russell 2000 will keep on rising. It can fall as well, except that it may fall at the lower magnitude or at a slower rate against the Nasdaq 100, given that this bull steepening curve is pretty much intact after that bullish breakout of that key former resistance of negative 0.08%. And even the momentum of the ratio starts to turn positive as well this week, right? 2 weeks ago, in fact, not 2 weeks, in fact, 4 weeks ago, it started to turn positive. The momentum of this ratio of the Dow Jones slash Nasdaq ratio and the Russell 2000 slash Nasdaq ratio. All right, so this is the intermarket dynamics I want to share with you all that could potentially be persistence in the next longer time frame, I would say, from a multi-week to multi-month perspective. All right, so with that, now let me focus on the short-term intraday technical outlook, starting with the FX market first. All right, so with that, let me expand my screen so that you guys could actually see. Okay, give me a minute. Okay, let me start with the FX market first on the euro dollar. So on the euro dollar over here, let me look at the daily chart. So on the daily chart, right, yesterday, because of that, how they react according to the number of posts that's being counted. Previously, it managed to survive during the Asia session at 1.075, which is very important. So this 1.075 is in fact the major symmetrical triangle range support level that has taken shape since about a year ago. Yesterday, it clearly broke down this level. So potentially from a multi-week to a multi-month perspective, because this is the daily time frame chart, the odds right now is more skewing towards more euro dollar weakness. Next support level to watch from a multi-week to multi-month perspective, or multi-week perspective, I would say is at this level, 1.062, and potentially it could revisit previously about a year ago low, which is the 3rd of October swing low at around the 1.05 level. All right, so this breakdown of that 1.0750 give us a higher odds that the euro dollar will be likely trading into a multi-week bearish bias. All right, so that's for the daily time frame. Then how about on the hourly chart over here? So on the hourly chart, what we could see right now is what I call it is an erase or adjustment after hitting the oversold level yesterday. All right, it's an adjustment now. So now potentially at this 1.2845 minor support level that was last Friday minor swing low that was tested yesterday 2 times during the start of the European session and as well as the start of the US session before taking a bounce. So right now it's trying right now to actually we call it erase off that previous overbought sold condition, and the hourly RSI now is bouncing back towards the overbought region again over here. So in a very short term intraday basis, there could be some form of minor bounces as we head into the London session and even into the US session today. And today there will be a key event happening in US, which is the FOMC meeting. Later I'll touch more about that on when I cover the FOMC meeting, and I will cover what is the market expectation right now for the Fed on the Fed funds futures contract. Right. So potentially there could be some form of minor bounces as the RSI try to work out from yesterday's oversold region. So minor bounces level to watch out will be at 1.240 followed by 1.2990, and this 1.22990 is also the this yesterday's US election induced steep intraday sell-off that close to that 76.4% Fibo retracement that confluence with the downward sloping 20-day moving average. So what I'm trying to actually express myself over here is that the weakness is still there on the weakness is still there on the sterling dollar. Okay, what I'm talking about it. Sorry, my apologies. I should be talking about the euro dollar. Okay, I repeat again. What just now is my error. So later I'll touch on the sterling again. So my apologies just now earlier on. This is the euro dollar, the euro dollar. Okay, so the euro dollar collapsed yesterday, broke down the 1.0750 level. All right, so right now the RSI is at the oversold region, and with the oversold region, there is also a bullish divergence that's being flashed out on the euro dollar. So what we could see now is the euro dollar is now trying to work out or work out from this oversold bullish divergent region and potentially shape a minor bounce as we head into the US session thereafter today. And also in the US session, there's also this risk event that is taking shape, which is the FOMC meeting. And with that, potentially the bounce level to watch on the euro dollar, the minor bounce will be back towards the pullback line of this former major range support that I highlighted earlier on the daily chart of the euro dollar at this 1.075, 1.0780 level. And maximum bounce that it could go potentially will be at 1.0830. So that is my short-term pivotal resistance that I have today for the euro dollar. We also confluence with the downward sloping 20-day moving average 1.0820. So if I were to do the Fibo retracement of yesterday's steep sell-off induced by the US presidential election risk event is confluencing with the golden ratio as well as 0.68%. That means, i.e., once the prices come close towards this region over here, this level here, I will potentially flip to a bearish bias on the euro dollar using 1.0830 as my short-term pivotal resistance level. Support level to watch on the near term will be at 1.0670, 1.0605 level. So this level here, 1.0605, in a minor support level is actually, if you go all the way back, right, is this here, the 17th of April 2024 low. Okay, so now if price action thereafter the bounce went up but can't be contained at the 1.0830 short-term pivotal resistance level, then today's intraday bearish bias will be invalidated with an hourly close above 1.0830 to see a potential squeeze up to revisit 1.0870, followed by the swing high that induced the yesterday's sell-off, which is at 1.0940 slash 1.0955. Okay, so that's for the euro dollar. So now with that, let me touch on the sterling dollar. My apologies, just now I have I saw that chart. So very similar on the sterling dollar as well. It's now trying to work out from its oversold region. So there could be now minor bounces as we head into the London and the US session. And also in the London session that later on, there is actually a Bank of England meeting as well. So potentially this bounce level to watch that could potentially evolve right now as the RSIs try to work out from its oversold region that was hit yesterday during the US session. Okay, 1.2940, maximum 1.2990. All right, so this 1.290 also confluence with the 20-day moving average, and just now I do the Fibo retracement. It actually coincides with the 76.4% Fibonacci retracement ratio as well. So as long as this minor bounce didn't potentially surpass 1.2990 level, I would flip to a potential bearish bias on the sterling dollar. First near-term support level to watch will be at 1.2845, followed by 1.28 figure, then thereafter followed by 1.2750, which is the minor descending channel that I drew from the, okay, in fact, it's a medium term because it's more than a month already. So it's a medium term descending channel lower limit that I drew from the high of 30th of September. Only a breakout with an hourly close above 1.2990 would invalidate today's intraday bearish bias to see another round of mean reversion rebound taking shape on the sterling dollar again, exposing the next near-term resistance level at 130.60, followed by 131.10, which is the minor swing high area of 9th of October, confluencing with the 50-day moving average, I think, as a resistance level as well. Okay, so that's for the sterling dollar. Okay, now turning our attention will be the Asia Pacific currency, starting with the Aussie dollar first. So the Aussie dollar yesterday returned neutral as well. So the price actually plunged, hit the first support after it broke the neutrality limit, and now starting to shape that bounce as well. So this bounce as well over here is also previously trying to work out that oversold condition that was made during the Asia session yesterday. So net what I'm going to do over here is that I'll be using 66.45 as my short-term pivotal resistance level for today on the Aussie dollar that confluence very closely with the 200-day moving average and as well as the 20-day moving average as well, acting as a resistance level. So as long as this level 66.45 on the Aussie dollar is not surpassed to the upside, we will flip to a intraday bearish bias on the Aussie dollar with the first support coming in at 1065.50, right, at 65.50 level. Okay, let me put it in writing. Okay, at 65.50, only a breakdown below 65.50 will revisit 65.20/65.10 next on the intraday basis. However, if price action starts to have an hourly close above 66.45, then today's intraday bearish bias will invalidated to see another round of mean reversion rebound to revisit 66.90/67.20 next near-term resistance level. Over here, this is the congestion zone of 22nd of October and 21st of October, which confluence, the upper limit is being confluenced by the 50-day moving average acting as a resistance. So that's for the Aussie dollar. Now, taking into account of the dollar yen over here. So the dollar yen yesterday, we have a neutral bias. So price action didn't broke above the upper neutrality limit at this 15470/80. And what's interesting over here is that the dollar yen now start to shape a bearish divergence over here. All right, there's a bearish divergence. So potentially there could be some form of minor setback over here. So I'll be using 15470/80 as my, this is a medium term pivotal resistance that I highlighted earlier on the daily time frame chart. So this one, okay, so back to the daily time frame chart. So this is the medium term pivotal resistance over here, right, that we highlighted earlier on. So since it's at the medium term pivotal resistance and with the hourly RSI shaping that bearish divergence, we will flip to a intraday bearish bias for at least a minor pullback or setback scenario to unfold. First near-term support level to watch for today will be at 153.50. Only a break below 153.50 exposes 152.45. All right, so these are the two potential near-term support level to watch for this potential minor pullback or setback scenario that could potentially unfold. Unless price action have an hourly close above 154.80, then this intraday bearish bias for this potential minor setback or pullback scenario will be invalidated to see a continuation of the squeeze up towards the next intermediate resistance level at 15620 level. All right, over here. So 15620 is in fact this congestion area here previously of late July this year. So that's for the dollar yen. Right. With that, let us now turn our attention to the major stock indices, starting with the Hang Seng Index first, or the Hong Kong 33. So the Hong Kong 33 right now continues to be trapped below the 21,050 short-term pivotal resistance that we highlighted yesterday. So yesterday there was actually a sell-off after the the price actually trade lower after the US presidential election outcome, where Trump is getting more clarity of winning the US presidency, and right now potentially it could be also a clear sweep of Congress in US. So the fear of this Hong Kong 33, why it's not trading in line with the US major stock indices, is because of that potential higher trade tariffs that could be impacted on Chinese products going to US. And we know that Hong Kong stock market is also a kind of a strongly directly correlated to the state of the US, the state of the Chinese economy. So with that, I'll be still using the 21,050 as my short-term pivotal resistance level, still keeping that bearish bias, but first support level to watch will still be 20,150. That was almost reached yesterday during the start of the US session before shaping that bounce. Unless we start to see a clear breakdown of 20,150 with an hourly close below it, then this potential intraday bearish bias will potentially extend to test the medium-term pivotal support zone at 19,790/19,445, which correspond to the rising 50-day moving average. If we have an hourly close above 21,050, then this intraday bearish bias will be invalidated to potentially see at least a short-term recovery on the intraday basis to revisit in the first step the next near-term resistance at 21,550. So that's for the Hong Kong 33. Now, turning our attention will be the German 30 as well. So the German 30 will also face the onslaught of these potential trade tariffs, potentially coming up from the US against European products heading into the US economy. So that actually explains why it actually tumbled all the way down to revisit last Thursday swing low area. So yesterday we do have a bearish bias on the German 30. It hit the support level over here. So potentially there could be some form of retracement coming back into the picture given this very steep sell-off yesterday. So I'll be using a tighter short-term pivotal resistance for today at 19,315. So if you do the Fibo retracement, that's correspond around the 50% level. All right. So 19,315 as my short-term pivotal resistance level on the German 30 for any potential bounce. So as long as this bounce is surpassed 19,315, I will still maintain that intraday bearish bias on the German 30. Below 19,020 exposes the next near-term support level at 18,960, followed by 18,890/18,850. All right, only an hourly close above 19,315 will invalidate today's intraday bearish bias to see a squeeze up to revisit yesterday's swing high area. In first step, 19,410, followed by 19,510/19,560, which is yesterday's minor swing high area that induces that steep intraday sell-off on the German 30 index. So that's for the German 30 intraday technical outlook, still maintaining that intraday bearish bias with a tightened key short-term pivotal resistance at 19,315. Now, turning our attention will be the US major stock indices, starting with the Wall Street 30. So the Wall Street 30 yesterday we flipped to a intraday neutrality stance because of a steep rise, and it almost hit our resistance level at 43,060 at the point in time. So market going to push up, form a fresh all-time high, and right now it's coming very close to a Fibo extension level at 44,220. In fact, it stopped at one extension level at 43,930. And what's interesting over here is that the hourly RSI has started to shape this bearish divergence. So we know that all price action, it moves in cyclical form, and given this very steep up movement yesterday of the the Wall Street 30 or the Dow Jones Industrial Average, on the Elliott wave perspective, this could be the fifth wave target at 44,220. That's coming very close to it at 0.382. That means this wave 1, wave 2, wave 3, wave 4, wave 5, and with a fifth wave target coming close at 44,220. and a bearish divergence being seen on the RSI, there could be a minor setback to retrace certain portion of this steep rally that has taken shape yesterday. So with that, I will flip to a intraday bearish bias because this is the intraday technical outlook. But from a multi-day perspective to multi-week perspective, like flash you earlier on the intermarket dynamics analysis, the trend is still bullish on the Wall Street 30. It's only the intraday basis that could be some form of minor setback after this steep up move with a fifth wave target, elliott wave upside fifth wave target coming close at 44,220, coupled with a bearish divergence on the RSI. So using 44,220 as my short-term pivotal resistance level, we will flip to a intraday bearish bias. Like I stress again, it's an intraday basis, potentially for a minor setback to take shape at 43,370 in first step, which is the former all-time high area. Below it exposes 43,060 level. All right, so if we do the Fibo retracement, just in case, let's say this is the already the fifth wave target, not at this level, okay, is at 38%. All right, so if we do the, let's say the price extend to this level, it's close to the 50% level mark. All right, over here. All right, then thereafter, once the price come close to this level, which is all very close to the 20-day moving average, potentially the US Wall Street 30 could resume its impulsive up move again. Okay, but however, if price action continues, instead of shaping that expected minor setback or the preferred minor setback that we have for today, but price action going to rally and push up above 44,220, then we got to respect this very steep impulsive up move, potentially opening up scope for the next intermediate resistance to come in at 44,700 / 44,730, followed by 44,900. Sorry, 44,990 next. Okay, it's a 0.764 Fibo retracement. Okay, 990. Okay, and also this 44,990 also confluence with this major ascending channel upper limit. Okay, if you go to the daily time frame chart over here, this major upper limit is I drew from the low of October 2023. Okay, so that's for the US Wall Street 30 at risk of a potential minor setback below 44,220 short-term pivotal resistance that we have for today. Okay, very similar price action also has taken shape on the Nasdaq 100 as well, as it hit past the fresh all-time high level over here. So this one is the 3.618 Fibo extension over here at 20,925. All right, 20,925. So for the Nasdaq 100 is a bit different. So this Nasdaq 100 here, this move up over here could be a wave 3 instead. So this is a wave 1, wave 2, wave 3, with the wave 3 target extension target at 3.618 at 20,925. So if we do the fifth wave target, we in this wave 3, we talk about 1, 2, 3, 4, 5. Okay, let's do it from here, push it from here. You realize that the 0.618 fifth wave target of this wave 3 also corresponds very closely to the 3.618, a Fibo extension cluster at 20,925. And now coupled with the RSI shaping that bearish divergence, we know that this steep move up here from all the way up from Monday all the way up to yesterday US session is a bit overstretched. So there could be a risk of a minor pullback first taking shape before another new impulsive up move kickstart on the Nasdaq 100. All right, so on the intraday basis for today, we'll flip to an intraday bearish bias. 20,925 short-term pivotal resistance level. First support level to watch will be close to the current this minor swing high area that was taken out on 30th of October at 20,640. Okay, 20,640. A breakdown below it exposes 20,500 next. So if you do the Fibo retracement, okay, over here, okay, let me remove this so that you guys could have a clearer image of the Fibo retracement level. Okay, that corresponds to the 38.2% Fibo retracement, which is potentially that wave 4, the corrective target as well in terms of the Elliott wave perspective. All right, and maximum will be the, okay, let me erase this or hide this. Oops, this. Okay, so that correspond to the 61.8%. If 20,500 breaks down, also maximum 20,295, which is the 20-day moving average, I think as a support level. However, a price action, instead of shaping that desired or anticipated minor setback, potential setback, it start to squeeze up and have an hourly close above 20,925, then this rally will go to extend on the upside. We're going to respect the impulsive up movement. Next resistance level to watch out for will be 21,100, followed by this 21,220 next. All right, over here. Okay, so that's for the Nasdaq 100. Now, let us now focus our attention to the commodities market, starting with gold XAU/USD. So recall that gold XAU/USD, yeah, since Monday, we do have that bearish bias. So the bearish bias indeed came down as expected and hit our support level at 2,667. Okay, this area it hit. And right now, what's interesting is coming very close to the 50-day moving average. So this potential mean reversion decline scenario from the high of 31st of October all the way down to yesterday's or today's Asia session low, more or less has really met its desired objective. And with that, the RSI right now is shaping a bullish divergence as well. Okay, so with this bullish divergence that's being made and it's coming very close to the 50-day moving average, I think as support, we will now flip to a intraday bullish bias back again on gold XAU/USD, given that there's high odds that the mean reversion rebound, or no, the mean reversion decline, pardon me, the minor mean reversion decline may have already hit its inflection level to kickstart another round of potential impulsive up move. So as long as 2,630 short-term pivotal support holds for gold XAU/USD, we'll flip to an intraday bullish bias, one step at a time first. First support level to watch 2,678, a breakout above it exposes 2,728, 2,715 on the intraday basis. However, if price action starts to break down below 2,630, then this mean reversion decline scenario will extend to visit the medium-term pivotal support zone at 2,600/2,590, which is this congestion area here of 9th of October and as well as 16th of September. Okay, so that's for gold XAU. Gold XAU/USD. Lastly will be the West Texas crude oil. So on West Texas crude oil over here, no change. Price action came down as expected, hit the first support before staging a bounce, and it can't break above the 73.15 short-term pivotal resistance level that we highlighted yesterday. So still using that 73.15 short-term pivotal resistance level, still maintaining that intraday bearish bias. First support level to watch will be yesterday's minor swing low at 70.50 level. Right, 70.50. Only a breakdown below 70.50 potentially revisit 69.50/68.85. But however, if price action managed to stage hourly close above 73.15 level, today's intraday bearish bias were invalidated to see the continuation of this mean reversion rebound within this major descending triangle configuration. As it work up towards the upper limit of this descending triangle. Next resistance level to watch on the near term will be on the intraday basis 75.20. Above 75.20 exposes 76.70 next. Okay, so that's for the West Texas crude oil, and also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the calendar. So like I mentioned earlier on, today will be two key central bank meeting that is pretty much key. Will be the Bank of England monetary policy that will be out at 8 p.m. Singapore time. So market is expecting a cut, a 25 basis point cut to it, bring it down to 4.75%. And also Bank of England governor will speak thereafter at 11:15 p.m. Singapore time. All right, so what's up next will be the US Federal Reserve interest rate decision. So today will be just the interest rate decision, followed by the press conference and the release of that usual monetary policy statement. So there will be no release of the dot plot where US Federal Reserve official will forecast where will be the inflation rate be, growth rate be, and as well as the Fed funds rate be in the next 1 year or so. So during the press conference, Powell will be very likely quizzed on what's his view with pertaining to Trump policy and how does it impact US economy, inflation trend, as well as economic growth and the labor market. So we got to see how he responds to that. So very likely, I will say that he will state the same story again by taking things one step at a time. So market participants is expecting a 25 basis point cut to bring it down to 4.75, but that has already been priced in by the futures market. So you look at the futures market over here, the current pricing over here is to bring almost 100% now that the market is expected to cut by 25 basis point cut to bring it down to 4.75%. And what's interesting in the next meeting, which is in December over here, market is also expecting another 25 basis point cut. The odds is quite high at 70% to bring it down to 4.25%. Then thereafter, we'll start to see very shallow interest rate cut projection. Only 2 cuts are coming into next year. That means, i.e., markets are expecting to pause in January next year, do another 25 basis point cut in March next year, 75% chance to bring it down to 4% to 4.25%. Then thereafter, it pause again in May, and another cut in June, not very high, the odds at 56% to bring it down to 3.75% to 4%. Then thereafter, the Fed will going to stamp it all the way until October next year. Okay, or in fact throughout the next year as well. So potentially there only could be 2 cuts next year that's being priced in. That means a 50 basis point cut to bring it down to 3.75%. So that is also pretty much in line with the last dot plot that was released by the Fed meeting over here during the July meeting, where the September meeting, pardon me, where they project the Fed funds rate to be at 3.4% in 2025. The market is now expecting it higher to be at around about 3.75%, another about 25 basis point lesser. So it's more or less the same. So let's see today what Fed Chair Powell will actually give the guidance during the press conference. All right. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.